Ladies and gentlemen, welcome to my third lecture of my lecture series entitled Fractal Finance. In this lecture, we will talk about modeling dependency structures for financial assets. Again, like I mentioned earlier, this course is based upon the book The Misbehavior of Markets, written by Benoit Mandelbrot. To get started, how are dependency structures modeled in traditional financial research? First of all, in the first equation, what you see here are autoregressive models. What's happening here is that you have on the left-hand side a dependent variable denoted here as yt, and on the right-hand side you have the independent variables or the regressors. What you see here is that the dependent variable yt is dependent on its own legs. Now we have on the right-hand side a0 as the intercept term, the parameter that models the intercept term. Then we have a1 times yt minus 1, which is the first leg, plus a2 times yt minus 2, which is the second leg. And in this model here, we have a leg order of small m. That means we have parameters a0 to am to estimate, and we can do this via ordinary least square regression. We have also here an intercept term, the error term denoted as epsilon, and this epsilon term is usually assumed to be distributed as normal with mean 0 and standard deviation sigma. But of course also different innovation processes you can think of. So this epsilon, this is the innovation process, and this is independent distributed. So the dependency structure here arises from the own legs of the dependent variable. So this is the autoregressive model, and in general form it's the RM model, depending on how many legs you want to include in your model. Another model class are the moving average models, which you see here, which is the second equation here. The yt is dependent on what? On epsilon t, which is again the innovation process that is independent distributed. But here, the legs are from the innovation process itself and not from the dependent variable. So we see here the legs epsilon t minus 1, epsilon t minus 2, until epsilon t minus n. So here we have a moving average model of order n, or an MAN model. Again, the parameters b0, which models the intercept term, b1, b2, until bn, they have to be estimated, but this time we have to use some nonlinear optimization procedure. We can also combine these models, autoregressive and moving average models. Then we are in the class of ARMA models. Here we have the autoregressive moving average models, which you see here as the third equation, where we have on the left-hand side the yt, the dependent variable, and then we have on the right-hand side the set of regressors, okay? And we have here m legs of the dependent variable itself and n legs of the innovation process epsilon. Again, these parameters have to be estimated using a nonlinear optimization procedure. What is interesting here that one can show that these models are relatives to each other. What does that mean? For instance, we can represent an autoregressive model of order 1 by an infinite moving average process. Let's have a look at that on the whiteboard. So how can we show that autoregressive processes and moving average processes are relatives to each other? Let's consider the following simple autoregressive process of order 1. Yt is given by parameter a, times its self-legged, and a random white noise term. We assume, like previously, that this epsilon is distributed as normal with mean 0 and variance of 1. Moreover, remember that the absolute amount of the autoregressive parameter of order 1 needs to be element 1 and 0. So in economic magnitude, it must be smaller than 1. Otherwise, we have an explosive process. So, given this equation here, we know that the yt at time t minus 1 is given by parameter a, the autoregressive parameter, times yt minus 2. Again, lag 1 period, plus the innovation process epsilon at time t minus 1. Now we can simply plug in this yt minus 1, what we have here, and on the right hand side we can plug it in here in the first equation, and what we get is the next row. So yt is then what? It's a times what is here on the right hand side in parentheses plus the innovation term epsilon t. If we multiply this out here, what we get is a to the power of 2 times yt minus 2, alright, plus a times the innovation process at time t minus 1, alright, plus the innovation process at time t. Now we can iteratively proceed here. Now, okay, we can ask the question, what is yt minus y at time t minus 2? Alright, so it's a times yt minus 3 plus the innovation process epsilon at time t minus 2. Again, we can plug in what is here on the right hand side, right? We can plug it in here and we do the same all over again. If we multiply this out, what we get is yt is what? It's equal to a to the power of 2 times, in parentheses, what is in this line here on the right hand side, plus the residual from here on the right hand side, which is a times epsilon t minus 1 plus epsilon t. If you multiply this out, what we get is this expression here in this row, which is yt is equal with a to the power of 3 times yt minus 3 plus a to the power of 2 times the innovation process at time t minus 2 plus a times the innovation process at time t minus 1 plus the innovation process at time t. So we see here, we can already see a pattern here. If we repeat this here iteratively, capital N times, what we end up with is simply that yt is what? It's a to the power of n, okay, times yt minus n. Alright? We see this here, this obvious similarity here. Plus, then we have to take the sum of what? Of a to the power of I times epsilon t minus I. You see? It's always if the parameter and the lag have the same order. Okay? Plus the innovation process at time t. Now, as capital N goes to infinity, what we have here, this is 0. So if we have a number, let's say 0.9, if we take a process that has the autocorrelation coefficient here, a, equal with 0.9, in the first iteration, a squared is 0.81, right? It's smaller than 0.9. So, and if we square this again, if we take 0.9 to the power of 3, it's even smaller. So it decreases, obviously. It decreases. If n increases, the autocorrelation coefficient becomes smaller and smaller and smaller, and eventually it reaches 0. So what is here on the, what remains as capital N goes to infinity, what remains is here on the right hand side the autocorrelation pattern of the innovation process itself, which we see here. Yt is simply the sum from I1 to infinity of a to the power of I times the innovation process, epsilon t minus I plus epsilon t. Now we have simply shown that an autocorrelated process can be transferred to a moving average process. Therefore, these two processes are relatives. So how do these things look like in practice? So what I have done here is I have simulated an autoregressive model of order 1, which you see here in this equation above. Yt is dependent on its own leg, t minus 1, and the parameter a. And again, we have an innovation process, epsilon t, which is here assumed to be normally distributed with mean 0 and a variance or standard deviation equal to 1. Obviously, if you take the square root of 1, it's 1. So it doesn't matter if you refer to it here as a standard deviation or the variance in this notation. What is important to know is that this a, this parameter, this autoregressive parameter, or first order autoregressive parameter, the absolute amount of that parameter needs to be smaller than 1. If it would be larger than 1, we would have an explosive process. But this model class is designed for stationary processes. So some processes that circulate around some mean, okay? That is important to bear in mind. So here in this case, this a parameter, I set it equal to minus 0.9. And again, you see that is like a broader, like a border case because it must be larger than minus 1. So this is very close to minus 1, but not exactly. So what you see here is a process that is clustering all the time. So each large deviation is followed by another large deviation. But the interesting thing is here that this process bounces back all the time. So let's say you have an observation that is in one period 2 standard deviations away from the mean on the positive side, plus 2 standard deviations. In the next period, what would you expect? You would expect this process to bounce back to have minus 1.8 standard deviations below the mean, plus something that is on average distributed with a mean of 0. Because the innovation process, as you see here, has a mean of 0. So this process, when it had large positive deviations, it will be followed in the next period by one large negative deviation on average. So it bounces always back. So and this is what is called anti-persistence. Such a process is highly anti-persistent. It bounces always back. So what I have done here, I have visualized the evolution of this process. First, I have normalized it. What I have done is each observation, I subtracted the mean of that process, yt, divided by the standard deviation. This is how you normalize this process. And the red graph here visualizes this process, the evolution of this process. Of the standardized process, whereas the blue graph here visualizes the evolution of a process that has where the parameter a is 0. And what is that? It's simply a normally distributed process. Because if a is 0, what remains here on the right-hand side is just the innovation process. And that's assumed to be normally distributed with mean 0 and standard deviation of 1. So I plot here these two processes against each other. So recall, the blue process has no dependency structure. It is memoryless. It's a white noise. Whereas the red process here has a high level of dependency, namely anti-persistency. And you can see here, if you just have a visual look at it, there's no possibility to forecast the blue process. Whereas the red process, you see, there are clusters, it's clustering all the time, and here you can forecast what is happening in the future. Next, let's take now the other extreme. So we have, first of all, we have modeled a process that is has a point estimate is negatively autocorrelated with a parameter of minus 0.1. Now we take the other extreme. We consider what's happening if the parameter A is 0.1. So this is a process that is close to be integrated. If A would be 1, it would be a random walk, right? But here, this process is forced to mean revert, because this A is smaller than 1. So what's happening here? So once the process, let's say in one period, the process is 2 standard deviations above the mean. You can expect this process here in the next period to be on average 1.8 standard deviations above the mean. So large standard deviations into the positive direction are followed by large standard deviation in the positive direction in the next period, on average. So once the process is in the positive side here of the payoffs of the YT axis, it will remain there sometime until we have a large negative deviation, which forces the process to go below the mean. And then it will stay there sometime, because here we have a persistent process. So processes, autoregressive processes of order 1 are persistent if the point estimate, or if the parameter A is larger than 1, is larger than 0 but smaller than 1, and it is modeling anti-persistence for parameters that are from 0 to minus 1. But recall again, the parameter A must be, or the absolute amount of the parameter A must be smaller than 1. So these are two examples of highly persistent process and a highly anti-persistent process that we can simply model via an RL1 process. Again, I standardize this first order autocorrelation process here, positive first order autocorrelation process, to have a mean of 0 and a standard deviation of 1. And again, I plotted against a normally distributed process. Again, here the blue line corresponds to the normally distributed process, which has no memory, which is independently distributed by construction, and the red graph here models the autoregressive process of order 1, where we have a parameter of 0.1 that models the first order autocorrelation function. Now you see here, again, the blue graph, there's no forecastability here. It's a white noise process. Okay? So the observation of today has no information of what will happen tomorrow. But the red process here, you see, there's a high degree of predictability, because you know if the process is now in this time period 2 standard deviations away from the mean, the odds are very high that in the next period it will be still large away from the mean in the positive direction. So now you may wonder, what has all this to do with finance? Well, some examples for applications of autocorrelation in finance is given here. So let's consider again a process YT. We have an intercept term modeled via the parameter C, and we have 12 lags in this model. YT minus 1, YT minus 2 until YT minus 12. And the corresponding parameters A1 until A12. So now we have to bear in mind that the sum of the autoregressive parameters here, the AIs from I is equal to 1 to I is equal to 12, so the cumulative sum of these parameters, of the autoregressive parameters, needs to be, the absolute amount needs to be smaller than 1. Again, otherwise we would have an explosive process, but this is what we do not want to allow for, because here we want to model a stationary process. So let's again assume in this model here that the epsilon t is normally distributed with some mean mu and some variance sigma squared. We can now also summarize the parameters, the autoregressive parameters here. Let's define the parameter b, and this is just the sum of the autoregressive parameters a1 plus a2 and so on until plus a12. Yeah? And again, this parameter b needs, the absolute amount of the parameter b needs to be smaller than 1. So in the asset pricing literature, yeah, there is a model proposed for return predictability, and this is what you see here. Yeah, it's yt, again, equal to a constant modeled here as c plus this parameter b times the sum of the lags of itself. And now we can think of yt as a return process of some asset. And again, because this is a regression model in essence, we have to include here an intercept term, an innovation process, right? Or a residual process once we have performed the regression. So this effect here, so if you have, let's say you have real life data, you have a data vector of returns, yeah? So you can compute a vector that gives you the cumulative return of the past 12 months, yeah? And you can just regress an asset, the return vector of some asset return on its own, of the cumulative sum of its own past returns. Okay? So the momentum literature proposes that the parameter b should be positive, statistically significantly positive, yeah? Because it suggests a positive autocorrelation. So if past returns, if the cumulative past returns are high, the future return of that asset at time t plus 1 will be high on average. Whereas if the cumulative past return is low, the future return of that asset will be also low. The spread between portfolio of high minus low cumulative past returns is on average 1%. This is what this momentum literature suggests. So another popular effect is the short-term reversal effect, which proposes return predictability of the following model, which you see here below. Again, yt, you can think about it as some return process of some asset. Here in this model, you simply regress it on a constant term, yeah, and on one leg of itself. Yeah. So this literature suggests that the parameter a1 should be statistically significantly negative. Why is that? Well, the short-term reversal effect suggests that assets that have performed very poorly in the last month, on average, they will outperform those stocks that have performed very well in the recent past month. The spread, again, is roughly, if you buy those assets that have performed very, very poorly and you short sell those assets that have performed very, very well, the spread should be around 1% per month. Quite similar to the momentum effect. So the corresponding academic studies you see here, the first study, the momentum study, was originally studied from Jerash and Titman in the 1993 paper entitled Returns to Buying Winners and Selling Losers, Implications for Stock Market Efficiency, whereas the short-term reversal effect has been first proposed in the paper from Jerash from 1990, evidence of predictable behavior of security returns. Both studies have been published in the Journal of Finance back in the days. So these are just two examples on how autocorrelation enters the financial research sphere. So next, let's implement this simple model, that measures the short-term reversal effect, and let's fit it to Dow Jones 30 returns, covering the period 1896 until April 2022. So we have here almost 1,500 monthly observations. And now it's important to have in mind that this short-term reversal effect, this negative autocorrelation, has been proposed for single securities, single stocks, and then portfolios are formed based upon these first-order autocorrelation parameter, in essence. Whereas if we consider indices, it's the opposite. The effect should be positive. So, and this is in fact what we get out here. Here I collect the returns, I compound the simple returns of the Dow Jones 30 index covering this period here, almost 1,500 observations, and I regress the return vector on its own legs. I just move it basically and regress it on itself with one time period lagged. Also, in this regression model, I include an intercept term. Otherwise, the residuals obviously would not have a mean of 0. So what we see here is the corresponding point estimate for A1 is here 0.055. The t-statistic is 2.15 in rounded figures, and the p-value is 0.03. So if you would believe standard statistical inference, you would draw the conclusion that indeed the autocorrelation is positive. So once you invest in the Dow Jones 30 and the return was positive in the current period, it will be positive also on average in the next period. So this is what this model would suggest. Let's have a look now on the estimated residuals and the corresponding distribution, which you see here on the right-hand side. So we have 1,494 observations, and we see that the mean is basically 0, and this is how it should be, because we have here to deal with regression residuals. They should always have a mean of 0 if you include an intercept term in the regression model. So the median is 0.1968 in rounded figures. We see the maximum return is, or the maximum residual is 39%, whereas the minimum residual is minus 31%. The standard deviation is 5.26. Skewness is close to 0, but the kurtosis is 8.68 in rounded figures, much larger than 3, which is the corresponding value of the normal distribution. So we have already the intuition, or the intuition should tell us actually that this residual process is far from normally distributed. And if we use the Jacques-Barrat test, which has under the null hypothesis the normal distribution, we see the corresponding test statistic here in the output is 2005, and the p-value is 0. And what does it mean? It means that we reject the null hypothesis that the errors are normally distributed, which casts doubt, obviously, on the validity of the statistical conclusions that we have just drawn based upon the output on the left-hand side. So let's do now a simple sample split test, and this is also what you should do in your own research whenever you're dealing with time series analysis. What you should do is you should perform a sample split test in order to see if your model is valid or if it's specific to some sample only. So here on the left-hand side, we have the first subsample, having 748 observations. So again, we perform the same regression. We regress the Dow Jones return on its own legs, including a constant term in the regression equation. So what we have here, the first order autocorrelation parameter is 0.077, with a corresponding t-statistic of 2.11, indicating statistical significance on a 5% level. And we see the p-value here is 0.035, and a standard statistical inference will tell you that this point estimator is statistically significant, suggesting significantly first order autocorrelation in Dow Jones 30 returns. However, if we have a look on the right hand side, here we see the corresponding model estimates for the second subsample. So we see that the autoregressive parameter here is 0.01, close to 0, with a t-statistic of 0.28, and the p-value is 0.78 in rounded figures, which suggests, obviously, that this point estimate is for the second subsample statistically not different from 0. There is no effect in the second subsample. So the effect that we have measured for the whole sample is only present in the first subsample, or it's driven by the first subsample only. So obviously what we have measured is sample specific, which should come as no surprise. What's the problem here? So how is the point estimate A1 estimated? So what's the formula for it? Well, it's measured as what? It's a covariance between the Dow Jones returns and its lagged returns divided by the variance of the lagged Dow Jones 30 returns. That's the formula how our regression model estimates the point estimator for A1. But if the variance of lagged Dow Jones 30 returns are not defined, it follows that the point estimate A1 hat is not defined either. What can we say next? What if the variance of Dow Jones 30 returns, or of lagged Dow Jones 30 returns, is not defined? Well, it means that the point estimate of that A1, the point estimate A1 hat, given the information set omega s, will be not the same as the point estimate including the whole information set, conditional on the whole information set omega capital T. Now, provided here that the information omega s is a real subset of the information omega capital T. So why is that? Well, because if the variance is sample specific, it means that the variance in one sample is not the same as in the next sample, or the variance in the first subsample is not the same as the variance that you would measure in the whole sample. And we can think about the variance of variance in terms of the kurtosis. There's also an important issue to bear in mind. So let's have now another look at dependency. So first, let's have a look at some example where we can derive the normal distribution from a simple coin tossing game. So in the first game here, I toss a fair coin 100 times. If the coin tells me head, then I would win $1. If it tells me tail, then I will lose $1. I repeat this game 1,000 times. And for each of these games, including 100 coin tosses, I calculate the total win or total loss. So that means for the first game, right, if let's say I have 5 wins and 1 loss, the cumulative is obviously then 4. But I do this obviously for the whole 100 tosses in each of these iterations. So here we see the corresponding distribution, and we see here is that the mean is close to 0, the median is close to 0, which is typical for the normal distribution. The maximum is 30 wins, or a win of $30, and the maximum loss is minus $38. The standard deviation is 10.27 in rounded figures. Skewness is minus 0.11, which is close to 0, and the kurtosis is 3.14 in rounded figures, which is close to 3. And there's only one distribution that I can think of that has a kurtosis of 3, and that's the normal distribution. If we now apply the Jacques-Darrah test, to this outcome here, it gives us a test statistic of 2.83 in rounded figures. And the corresponding p-value is 0.24 in rounded figures. So what does it mean? So on a 5% level, we do not reject the normal distribution as a corresponding distribution of this data generating process. So next, what I do is I basically do the same experiment here, or the same game, but here in each iteration I toss a fair coin not 100 times but 10,000 times. So again, if head, then I win $1, if tail, I lose $1. Again, I do 1,000 iterations for each of these 10,000 times tossing a coin, and then I calculate the total win and total loss for each of these 1,000 iterations. And here again, I report the descriptive statistics. We see already here from the graph, from the histogram, yeah, it looks more and more like a bell-shaped curve, right? The mean is 1.34 here, which is close to 0. The median is slightly higher, it's 7. But anyways, in this, if we put this in relative terms to maximum and minimum, it's close to 0, basically. We see the maximum is 314. Recall, for the other game, we had 30. This is roughly 10 times larger than in the previous game. So, and now we have to think, okay, in the previous game we had in each iteration 100 coin tosses. Here we have 100 times 100 coin tosses, 10,000. So, but the maximum is 10 times larger than in the previous game. So, and 10 is the square root of 100 times larger. That's interesting. Is that coincidence? We will figure that out. Moreover, here we see the minimum is also roughly 10 times lower than in the previous game. The standard deviation is 99.08. Kurtosis is 3.03. Obviously it moves more to 3 now. The more more often in each iteration we toss a coin. Okay, if we would have 1 million coin tosses, yeah, kurtosis would be probably 3.000 and then some figures. Here again we can run the Jack-Barrett test here. It gives us here a corresponding test statistic of 0.54 in rounded figures, and the corresponding p-value is 0.76. Yeah, so obviously we do not reject the null hypothesis that the outcome here, the process, is a normally distributed process. So both games are memoryless because the increments are independently distributed. Yeah, so in each game, 50% probability that we have head and 50% probability that we will have tail. But let's consider now the following observation. So we consider now 10,000, the cumulative path of one iteration having 10,000 observations, 10,000 coin tosses. How does the payoff evolution look like for one of these games? If we consider the first 100 observations here only, we see within the first 100 observations the maximum is -1 after the first coin toss, and the minimum is -23. Then the process moves up again. So the difference between maximum and minimum is 24, given we consider the first 100 observations, the evolution of the payoff within the first 100 observations. If we consider the whole sample and we check, okay, what's the maximum and what's the minimum value of the process, we see the maximum here is 55 and the minimum is minus $69. So the difference for the whole sample, which is 100 times larger than the initial sample, is 124. So what we can say is the maximum, so the range between maximum and minimum, considering all 10,000 observations, is equal or less than 10 times the range between maximum and minimum given the first 100 observations. Because obviously 124 is smaller than 10 times 24, which is 240. So again, the sample in the beginning is 100, the total sample is 10,000. So the total sample is 100 times longer than the sample in the beginning. And 10, the factor, is what? It's the square root of 100, or 100 to the power of 0.5. So this is what we need to bear in mind here. And next, we can take another example here. Again, this is the same game, but it's a random game, obviously, so the outcome is random. So here, if you consider the first 100 observations, we have here the maximum is 1 and the minimum is 16. So the difference, so the range between maximum and minimum, is 17. If you consider the whole game, all 10,000 observations, the maximum is 66, the minimum is minus 49. Difference between the range of maximum and minimum for the whole time series here, having 10,000 observations, is 115. Again, 115, so the range between maximum and minimum for the whole sample is equal or less 10 times the range between maximum and minimum for the first 100 observations, which is 17. So again, so the factor 10, where does it come from? Or why is that? Well, what is 10? 10 is the factor that we have to multiply the first subsample of 100 observations here to reach the 10,000 observations of the full sample. Yeah? And 10, the factor 10, is the square root out of that factor. And this is true for processes that have no memory. So again, the increments here, the payoffs of head or tail, because we are dealing with a fair coin, are equally likely. That means the process is memoryless. That's a random walk process, simply. So we can now generalize that. So more general here. For an independent process, the range between maximum and minimum varies by the square root of the number of tosses or drawings. But knowing this, we can compute the multiplication factor, which tells us by what factor we need to multiply the range of maximum and minimum from the initial sample. Let's say we consider 100 observations. If we want to know the corresponding expected range for some extended sample, let's say here, like here, n is equal to 10,000 observations. So for an independent process, the slope of the curve is the square root of the total observations divided by the initial sample of observations, or having the number of full sample divided by the initial sample h to the power of 0.5, which is the same thing. So let's say our initial sample has, or our small h here, is equal to 100, like in the previous example. And that we want to know, okay, what happens, let's say we measure some range, we know the process is independent, yeah, and we want to know what is the maximum minus minimum, or what can we expect the range between maximum and minimum to be if we're dealing with, let's say, not 10,000 but 6,500 observations. So the answer is we have to take 6,400, which is now our capital N, divided by 100, which is 64, and the square root of 64 is 8. So if the initial range is, let's say, 20, yeah, 8 times 20 is 160. So we can expect that the range between maximum and the minimum will be equal or less than 160 if we reach 6,400 observations. So, and we see here the slope of this curve is the square root. It's the square root, or it's to the power of 0.5 or 1 over 2. So this is important to bear in mind. So now what I do now here is I simulate an R1 process, because now we know R1 process, it is a persistent process. We have dependency here going on. It's not an independent process. So I simulate an R1 process. Yt is equal to A times Yt minus 1 and then innovation process epsilon t. So here our A parameter, the first order autoregressive parameter, I set it equal to 0.9. Now it's a close to integrated process, but not exactly, as it's less than 1. Again, the innovation process I assume to be normally distributed with mean 0 and standard deviation or variance equal to 1. So first, what I do first, I simulate 12,000 drawings and then I cut off the first 2,000 observations because I want to have a well-behaving process. So then I compute again the cumulative observations. So we can think about it as payoffs again. Again, I have a look at the first 100 observations here. So within the first 100 observations, the maximum is 251, whereas the minimum is 151. So the difference between maximum and minimum, the range, is 100. For the whole sample, however, which has again 10,000 observations by construction, the maximum is 289 and the minimum is minus 1,359. So the range between maximum and minimum for the whole sample is 1,648. And that's much, much larger than 10 times 100, which is 1,000. It's more than 1.5 times larger. Recall now, if this process here, that for independent processes, this sign should be smaller or equal to 10 times 100. Or 10 times the range of maximum minus minimum for the first subsample. So that's the difference between processes that have a high level of dependency and processes that are memoryless, respectively, that are independent. Now we can think about multiplication factors for various processes. So recall that the gray line here, the gray curve, that's the corresponding multiplication factor for the range of max minus minimum for independent processes. And the slope of the curve is the square root. For a persistent process, we have seen in the previous example, it was larger than 0.5. Okay, the slope must be larger than the square root. So we have seen here, for instance, I have simulated a process where the corresponding slope is 0.75. Yeah, we see if we have a range in the beginning, let's say the range in the beginning is 20, and we have 100 observations in the first sample, and we go to 6,400 observations. We know if the process is independent, the maximum range should be less or equal to 160. But if the process is persistent, the range can be much, much higher. As you see here, the multiplication factor is in the neighborhood of 20. Yeah? So 20 times 20. So now we're dealing with 4,000, the range of 4,000 as opposed to 160. So we see it's very different. On the other hand, for processes For instance, if we're talking about negative autocorrelation, if the point estimate, remember this A is equal to minus 0.1, there we have a negative autocorrelation or an anti-persistent process. So for anti-persistent processes, the slope is less than 0.5, respectively less than the square root. So the range, let's say again, we have a sample of 100 in the beginning, and the range between maximum and minimum that we measure is 20, and we know if the process is independent, the maximum range for 6,500 observations would be less or equal to 160, right? Because the multiplication factor is 8, right? Here, it would be much less. It would be, let's say, 4, in the neighborhood of 4. So we can expect the range to be only equal or less than 80, because 4 times 20 is 80. So the range between maximum and minimum for the whole sample of, let's say, 6,400 observations should be equal or less than 80. So we see there's a huge difference, so that the dependency structures in the data give us a very different evolution of the range of maximum and minimum that we can expect to see in the data in the future. This is an important issue to bear in mind. The question is now, how can we model that? How can we get the slope of these curves? How can we estimate the slope of these curves in order to make forecasts? To estimate the slope of these curves, Mandelbrot proposed the so-called rescaled range analysis, which looks like follows. Here, on the left-hand side of the equation, we have the rescaled range statistic for cluster group K, and on the right-hand side, we have a constant C times K, which is the size of the cluster group, to the power of H. Well, H defines the so-called Hurst exponent. So Mandelbrot decided to dedicate this Hurst exponent measuring the dependency structure for some financial data, Hurst. And Hurst was a researcher who investigated the dependency structure of the river Nile. This story is detailed in Mandelbrot's book, and I highly recommend to get familiar with it, to understand the intuition behind this methodology. The Hurst exponent is defined on the interval between 0 and 1. We said earlier, if the slope of this curve is 0.5, which is exactly in the middle between 0 and 1, then we have an independent process. For instance, a normally distributed process should have a Hurst exponent of 0.5. Whereas Hurst exponents that are larger than 0.5 but smaller than 1 or equal to 1, this would indicate a persistent process. The more we move towards 1, the higher is the level of persistence. Whereas a process that is below 0.5, that is on the interval between 0 and 0.5, this would indicate an anti-persistent process, like we showed earlier. If we go back here to the previous slide, we see that the gray curve here has an exponent of 0.5, whereas the blue curve here has an exponent of 0.75, indicating persistency, and the red curve here has an exponent of 0.25, indicating anti-persistence. So how do we proceed here? We can estimate the Hurst exponent via log-log regressions. This is the traditional method how to retrieve or how to obtain the Hurst exponent for some data set. We have already applied log-log regressions earlier, so this methodology should not be something new to you. So we have simply here on the left-hand side the logarithm of the RS statistic for cluster group K, and on the right-hand side the logarithm of the constant, which is obviously, we are not interested in that, but rather in the Hurst exponent H, which is here in an additive manner, since we take the logarithm plus h times the logarithm of the size of the cluster group k. And because this is a regression, we have also an error term here, given by u. So Mandelbrot argued that one of the principal virtues of the RS statistic is that, in contrast to many other common statistical tests like correlation-based tests, it makes no assumption about how the original data are organized, and which is a critical point when studying something like stock prices, for which evidence abounds that the conventional assumptions are flatly wrong. On page 298 in his book, Mandelbrot defines the RS statistic, which you see here, as follows. So how do we proceed? How does it work out? So we have a cluster group K, and for each cluster group K, we have different clusters depending on the size of the cluster group. So for each given cluster group K, and each cluster within this cluster group, we take we demean the return divided by the standard deviation here. We compound the compounded sum of the returns. Then we take the maximum minus the minimum. And we do this for each cluster given a cluster group K, and then take the average across all clusters. So we see in the denominator here, this is simply the standard deviation. So we have to standardize for each cluster, in each given cluster group, the data. So, and then given the cluster groups, so let's say we have 8 cluster groups, so we have then obviously in our log-log regression 8 data points. So again, let's have an example. Let's say we have 1024 observations. Then we can operate obviously with n equal to 8 categories of clusters, where each category consists of the following data clusters: 512, 256, 128, 64, 32, 16, 8, and 4. So obviously, we see that all these categories are a multiple of 2, which is an important issue here. But we come back to that soon. So we have 8 data points for the log-log regression, 8 data points on the right-hand side, so 8 sample averages of this RS statistic given each cluster group K, and we have 8 data points on the right-hand side, because we have simply 8 different cluster group sizes, ranging from 512 until 4. So since we have one parameter for the intercept term and one parameter for the slope in the log-log regression, okay, the C and the H, obviously, the reference distribution is a t-distribution with 6 degrees of freedom, which is important for statistical tests. For instance, if you want to know, let's say we have a Hurst exponent of 0.6, and we want to investigate if it's statistically different from 0.5. So we want to know if the process is persistent or is it statistically still an independent process. So then we have to know what is the corresponding reference distribution for the error term, and also for the Hurst exponent, of course. So in the first operation, we operate with the cluster group 2 to the power of n, and n is 1, right? So that means we have 2 clusters. Given that we have 2 clusters, that means we divide the whole sample of 1024 observations into 2 samples of equal size, here 512. And then we calculate our RS statistic for that cluster group. In the next iteration, we operate with 2 to the power of n, and here now n is 2, with 2 to the power of 2 is 4, so we have 4 clusters in that cluster group. And that means we divide the overall sample by 4, and that means we have in each sample 256 observations. So we do that until we reach the last cluster size, so where we have 2 to the power of 8 observations. 2 to the power of 8 clusters. That means we have 4 observations in each cluster group. So in order to provide an illustrative example, let's have a look on the first iteration on the whiteboard. So how does the first iteration look like when n is equal to 1? Recall that we pointed out earlier that n needs to be element of the natural numbers. Yeah? So we can write here that our n needs to be element natural numbers. In our example, we argued that n goes from 1 to until 8. So in the first iteration, n is equal to 1. And we said then we have 2 subsamples. So how do we come up with that? We simply divide the total number of observations, 1024, by 2. And again, what is 2? 2 is 2 to the power of n, and n is 1. 2 to the power of 1 is 2. In the next iteration, obviously, n would be 2, and then we would divide this number here, the total number of observations, by 4 instead, and so on and so forth. But now let's just have a look on the case when we are in the first iteration. So knowing that means that we have to deal with 2 subsamples. So we have to divide the whole data vector into 2 subsamples of equal length. First, we have to store the results of our subclusters in some vector. I have it denoted here. I have here a 2x1 vector because we have 2 clusters here of size 512 observations. So we have to store the corresponding RS statistic for each of these clusters in some vector. So next, okay, we have our data vector here, 1024 observations, and here this vector is transposed, so it should be actually a column vector. We use the first 512 observations here, axis 1, 2, until 512. So this is our first subcluster here, the first observation subcluster. And we subtract from each single observation in our first cluster the corresponding mean of the data vector here, of that data vector. This is what we have denoted here. It's a 512 by 1 vector, unsurprisingly. So, and this is what it means. So x1 denotes simply the 512 by 1 column vector of data observations, and we subtract from that data vector the sample average of that subsample here. Very simple. This is a 512 by 1 vector. We do the same thing for the second subsample, for the sample observations 513 until 1024. Again, from each single observation, we subtract the sample mean of that second subsample. We have it here. It's also a 512 by 1 vector per definition. We have it denoted here as x2 minus x bar 2. Very simple. So on average, what we have here, it is 0. The same is true here. On average, what we have here, because we subtract the sample mean, on average, that's 0. What do we then? So we use the demeaned observations and compound the cumulative total. Now we do this for both samples here, using these demeaned vectors. We compute the compounded return here, or the cumulative return, and then what we do then is we investigate what's the maximum here and what's the minimum. We take the range of maximum minus minimum for the first subsample, right, and divide it by what? We divide the range between maximum and minimum for the first subsample by the standard deviation of that vector here, which we know has a mean of 0. Okay? But it measures the uncertainty, it scales the range of the first subsample by the corresponding uncertainty, yeah, in that data vector. We do the same thing for the second sample here, x2 minus x2 bar. Yeah, here again we compute the cumulative return or the cumulative observations here. Yeah, and let's say this is what we get, this time series evolution here. And then again, we observe what's the maximum, what's the minimum. Now we take the range, maximum minus minimum, divided by the corresponding sample standard deviation. You know, the standard deviation of that second sample here. So what do we do then? Well, that's the rescaled range for the first subsample, or the first cluster, and this is the corresponding rescaled range for the second subsample, given cluster K. So provided K is equal with 512, yeah? Because that is the corresponding size of the cluster. So what do we have to do? So we have to take the average, so the mean of that vector here, and take the natural logarithm. This is what we have done here. We take the logarithm of the mean of the corresponding rescaled range statistic. And the second element here in the first row is simply the logarithm of the cluster size, which is in the first iteration 512. So obviously we can do this for all 8 iterations, yeah, until we end up here on the right-hand side with the logarithm of 4, because this is our smallest cluster size, all right? And the corresponding here, we have here we have to take the logarithm of 256 rescaled ranges, yeah, because this vector here obviously increases as the cluster of the data cluster decreases. This is how it works out, and what we get is here obviously then an 8x2 matrix once we have proceeded here with our 8 iterations. Again, let's say we operate with 1024 time series observations in the data vector, and hence with 8 categories of clusters K. So that is, again, we have clusters ranging from 512 until 4 observations, given a cluster group K. What we do then is we can compute the following 8x2 matrix. Now we have in the first column vector, we store the corresponding sample averages for each RS statistic. So for instance, in the first cluster group, we have 2 clusters. So our first increment here, so the RS bar for cluster group having 512 observations, has only 2. It's the average of 2 different RS statistics, because we have 2 clusters in that cluster group. So the RS bar for the cluster corresponding to 256 observations, there we have obviously, we take the average of 4 RS statistics, and so on. So on the second column vector in our 8x2 matrix is simply the logarithm of the cluster size. Yeah? So we can denote it here as RS bar and K, simply, the corresponding column vectors. So what we do then is we regress the first column vector, denoted here as RS bar, on K, including a constant. And obviously the constant must have also the dimension 8x1, all right? So we can define the matrix X then simply as 8x2 matrix that has in the first column vector is a vector of ones, 8 by 1 vector of ones, and the second column vector is the corresponding vector of logarithmic cluster sizes, k. So the point estimate for the Hurst exponent is then the second element of the 2 by 1 vector beta hat h, given by simply x transpose x inverted times x transpose times rs bar. So very simple OLS regression. So, and then recall that the residual process of the regression is distributed as t distribution with 6 degrees of freedom, which is of importance for hypothesis testing. So obviously, if we have, let's say, 30 cluster sizes, so let's say we operate with stick data and we have, let's say, 100,000 of observations, and we can operate with 30 cluster sizes. Then obviously, the distribution approaches a normal distribution, right? But since we most likely do not have that much observations, especially if we operate with monthly data, like we usually do in financial research, here, if we have 1,024 observations, in this case, we can operate with 8 cluster groups, right? And then the corresponding reference distribution is t distributed with 6 degrees of freedom. So Hurst's work, recall his work concerning the dependency structure of the river Nile, suggested decreasing correlations, but they decrease so slowly that they never seem to vanish completely. So no matter how far back in time you go, the question arises, is that reasonable? Usually in financial research or also in economic research, people operate with the lag order, autocorrelation lag order of, let's say, p. So at some point, they do not account for innovations or lags that are far away than, let's say, p. And we have, for instance, for the momentum effect, we go back in time 12 time periods, 12 months. For the short-term reversal effect, only one month. So again, operating with a decreasing correlation that doesn't vanish as time goes by, is that reasonable? Well, on pages 184, 185 in his book, Mandelbrot highlights this issue, the following issue, which is very interesting. So he writes, now think of finance. In 1982, IBM, then the world's biggest computer company, decided some upstarts at Apple were threatening its future with a new product called the personal computer. Uncharacteristically, IBM acted quickly. It bypassed its own big chip factories and software departments. It picked a struggling semiconductor company named Intel to make its microprocessors and a bright but insignificant kid named Bill Gates to provide its software. The rest is well known. Intel and Microsoft grew wildly beyond any imaginable bounds. IBM shrank, but the fates of these companies are still intertwined. The stock prices affect one another, as profits or troubles at one redounds on the business or market ratings on the others. That event of 3 decades ago, IBM's midwifery to 2 new industry giants, continues to reverberate today in IBM's stock price. The dependence there is about 30 years ago. One can easily imagine even longer dependence. The court-ordered breakup of John and Rockefeller's Standard Oil Trust in 1911 continues to affect its surviving children today: ExxonMobil, ConocoPhillips, Chevron, Texaco, and BP Amoco. So we see that the Hurst exponent obviously measures something that standard correlation-based methods do not measure. And there are at least 2 good reasons to use the Hurst exponent as opposed to correlation-based methods. So, and first, obviously, the Hurst exponent, or the methodology, makes no assumptions of the underlying data generating process. So it measures persistence and anti-persistence in some data. And moreover, it accounts for for effects that have a long-term effect on the data. This is something that standard correlation-based methods cannot account for. So let's consider now some simulation experiment that I implemented here, where I simulated autoregressive models of order 1. We discussed autoregressive models earlier in this lecture. We have a very simple model framework here. YT is dependent on some parameter, AI times its own legs. And we do not even account here for a constant term. And epsilon t, again, is an error term that is here assumed to be normally distributed to keep things simple here with mean 0 and variance of 1. So recall again, the parameter AI needs to be on the range, needs to be defined on the range between -1 and 1. It must be larger than -1, let's say at least minus 0.9, and smaller than 1. Otherwise, we would have explosive behavior that we do not want. And we want to have stationary processes. So I simulate 19 time paths with the varying parameter AI. Now I start with negative autocorrelation. So I set AI equal to minus 0.9, and then I simulate 1,024 observations for that process. Then I do the same all over again, but then I put the parameter AI equal to minus 0.8. Again, I simulate 1,024 observations of that data. So, and I do 19 different time paths here, from minus 0.9 in increments of 0.1 to 0.9. Then I estimate the Hurst exponent for each sample, and I plot the estimated Hurst exponent against the corresponding autocorrelation parameter of the respective time series. So I do not need to estimate the autocorrelation parameter because I know it already, because I have simulated the data. So on the curve, you see the association between autocorrelation and Hurst exponent here in this graph on the left-hand side. Now we see obviously there's a positive autocorrelation, but the link is non-linear. So again, actually, it is wrong to use correlation here to measure the correlation between Hurst exponent and autocorrelation. But what we can see here is that there's a positive relationship between Hurst exponent and autocorrelation. But the correlation between autocorrelation and Hurst exponent is here 0.9873. It's close to 1, perfectly correlated. The theoretical positive correlation should not come as a great surprise. Why? Well, as an autocorrelation parameter between that is larger than 0 but smaller than 1 suggests positive dependency, right? Whereas autocorrelation parameter between that is larger than -1 but smaller than 0 suggests negative, like anti-persistent behavior. But what is interesting to know here is that the range between the estimated Hurst exponent is from 0.39 in rounded figures, given we have an autocorrelation process that has a negative autocorrelation parameter of minus 0.9, whereas we have an estimated Hurst exponent of 0.89 for an autocorrelation process that has positive autocorrelation with an autocorrelation parameter of 0.9. So we see we have different ranges here. Now let's consider some real-life data. So what we use here is we are using Standard & Poor's list of survivor companies in the S&P 500 index. So I gathered data on survivor stocks that survived in this S&P 500 index between the March 1957 period and March 2007 period. So the list of these survivor companies is publicly available here in the internet. If you use this link, this was a press release from 2007 from the index provider. So The total sample consists of 92 original constituted companies. And this is actually something that a colleague of mine, Yao Han, figured out as he operated with the CRISP database and retrieved these companies. Using these companies, monthly return series from the CRISP database were collected. Again, this is what Yao Han has been doing for us for all these survivor companies, which had available data from September 1934 to December 2019. So why is that? Well, because first of all, our sample ended in December 2019, and we went back in time and had a look, okay, how many of these companies had data available, had 1,024 data points available back in time. So, and this data restriction enables sufficient monthly observations for implementing the RS analysis to derive the Hurst exponent. Overall, there are 34 out of 92 original constituted companies that met these data requirements. And note that I used the data also in the study Better Not Forget on the memory of S&P 500 survivor stock companies. And this study is unsurprisingly co-authored with Yao Han and another collaborator of mine, James W. Colari. And the study is already published in the Journal of Risk and Financial Management, which is as of now a rising finance journal. So what did I do? I fitted RR1 models to all 34 survivor stocks that had 1,024 data point observations available. 22 out of 34 firms exhibited negative point estimates for the first order autocorrelation parameter. So what's the story here? So obviously recall the short-term reversal effect, right? Which suggests negative autocorrelation. So if a stock has performed very poorly last month, it would perform on average well in the next month, whereas a stock that has performed very well in 1 month tends to perform poorer, let's say, in the next month. It's a short-term reversal effect. For 9 out of those firms, the negative point estimates were statistically significant in terms of its t-statistics, as the t-statistics were larger, were below minus 1.96. Yeah? So in using standard statistical analysis, you would regard them as statistically significant. Then, for these 9 firms that exhibited statistically significantly negative autocorrelation, I estimated the corresponding Hurst exponents. And this is what we can see here in the upper part. So you see the negative autocorrelations, they vary between, let's say, minus 0.06 and minus 0.12. Whereas the Hurst exponent, the estimated Hurst exponent, they vary between 0.53 and 0.65, roundabout. So we see that statistically significant negative autocorrelation does not necessarily imply anti-persistence. In the simulation setup that we showed earlier, there we saw, obviously, if a data set is well behaving according to the simulation, we see there's a negative, that there should be theoretically a negative relationship. But here we do not see that. Yeah? So we see that it can be at times that a process that has statistically significantly negative autocorrelation can be associated with high level of persistency. So obviously, what does it tell us? It tells us that the Hurst exponent and autocorrelation, they measure indeed 2 different kinds of dependencies. So the Hurst exponent recognizes something that autocorrelation cannot identify. So what next? I also estimated the corresponding Hurst exponents for those firms who had a positive autocorrelation but insignificant. So statistically, we would argue that that we have absence of autocorrelation because the positive autocorrelation parameter was statistically not different from 0. So on the other hand, we see that the Hurst exponent, the estimated Hurst exponent, they vary between let's say 0.6 and 0.67, implying a high level of persistency. So we see that the absence of statistically significant autocorrelation does not necessarily imply the absence of statistically significant dependency structures. The Hurst exponents are indeed statistically significantly larger than 0.5. So the test statistics for the estimated Hurst exponents, they are larger than 3 for the whole cross-section. The critical value of a t-distribution with 6 degrees of freedom, the reference value for the critical value is 1.94. Yeah? So 3 is obviously exceeds 1.94 by a substantial margin. So the Hurst exponent, so the positive dependency structure here, the persistency in the data is statistically significant, whereas autocorrelation is absence. So this is, I would say, a very interesting thing. So what happens next? In the next lecture that follows, what we will do then is we will discuss Benoit Mandelbrot's groundbreaking multifractal model of asset returns, the MMAR, which is capable of modeling both effects, the long-term memory and the discontinuity. Thank you for your attention.